Mayo, as well as Fargo Securities Managing Director, Senior Banking Analyst. He was named the #1 All-American Wall Street Analyst for large cap banks this morning, 5th year in a row. Well done.
Thank you.
No props today, though, right? Last time.
Nothing.
What did you bring last time? I forgot. Oh, you won your powerlifting.
Hammers.
Yes, powerlifting. Also a key power lifter as well. So he's got that and II. All right, let's talk the election. Give us a quick take here in terms of Trump, Harris, and why, from your perspective at least, there's still benefits for the financials on both.
Well, look, it's an opportunity no matter who wins. First, clarity. Just give clarity on the rules, whether it comes to the Basel III capital or even the stress test. Banks don't know their cost of goods sold until after the whole stress test. So Wall Street likes certainty over uncertainty. The second thing is common sense regulation. You've already seen this put in place under the current administration. They rolled back in that 1,000-plus page report about capital changes. So that's already in, the course of change. And the third thing would be, capable people in key positions. And so it's always an opportunity. You saw the news about Jamie Dimon in the New York Times, not confirmed by him or the company. But if you got people like Jamie Dimon going to government, that would go a long way. So no matter who wins.
It doesn't seem likely.
Not likely, but think about it. He could potentially be the second most powerful person in Washington, D.C. if he took it. And by the way, it might not happen day one. It could happen a year after the election, and they say, hey, Jamie, we need your help. Remember the global financial crisis, how much people relied on him. But the other thing is the fundamentals of banks, to a certain degree, transcends the election. You are having multi-year EPS inflection that starts now between the third and the fourth quarter. You're seeing inflection of traditional banking revenues. You're seeing inflection of capital markets. You're seeing inflection of operating leverage. So this is a real turning point after a few years of being in the doldrums. Now, with a Trump win, the consensus is, less regulation, more mergers. I saw the segment before this. You monetize more, the deal flow and capital markets gets better and a little less regulation. But at the same time, there's more concerns from our firm strategist, Chris Harvey, about, interest rates and inflation. Right. So there's no free lunch here. And under a Harris win, it's probably more of the status quo, all things considered, where you continue. You're still past peak bank regulation. Maybe just don't go as far past as you otherwise would.
We've already seen the volatility in rates. We're 65 basis points higher than the September lows on the 10-year yield, and the Fed has been cutting. And so how do you think about that sort of volatility as you look forward? Supposedly it's a more benign environment overall for small businesses, for, lending perhaps, if rates still go higher, even in the face of Fed rate cuts?
Well, remember the bond vigilantes? David Faber does. He's old enough, like I am.
He sure is.
Oh, yeah.
David's old enough. Remind me of how old I am. So he takes your place, Carl.
But if rates go up a lot higher than expected, or you have a second dose like you had during the Volcker years, then you're talking about, that capital markets backlog doesn't get monetized. The commercial real estate problems, gone, not they're forgotten but not gone, especially if rates stay higher for longer. The pace of loan growth, if rates stay higher, and then just overall servicing bad debts and the unrealized securities losses.
Right, like the Bank of America.
But, unrealized securities losses are half of their peak right now. Nobody writes about that, but they could go back up if you have a bad rate scenario.
Well, we still have a 4.3 10-year, too. That's not actually helping as much as you might have thought, given the 50 basis point cut we got.
Let me just say one thing that nobody talks about is the idea of an upward sloping yield curve. The old adage in banking was 3-6-3 banking. Borrow at 3, lend at 6, be on the golf course by 3. Banks had a spread. So if you do actually get a spread back, and you will one day, that could be the unexpected positive for banks.